One of the most popular dividend stocks of all time is the Coca Cola company. The company is currently up 6.19% year to date. Now, if we compare that to the broader market as a whole over that same period of time, we can see the returns over the past year have been pretty phenomenal. Now, the reason why this company is so popular is because Warren Buffett actually invested in this company 33 years ago, and it has performed extremely well since then. If we go over to Seeking Alpha and look at this dividend data, once this loads in, we will be able to see this company has actually been increasing the amount they pay in dividends for 28 consecutive years, and it has a 5-year growth rate of 3.62%. So in this video, we're going to be jumping into my stock valuation spreadsheet to see if this company is a company we should be buying or selling. And on the spreadsheet, we have our 4 valuations. We have Graham's valuation, a discounted cash flow model, multiples valuation, and a dividend discount model. And all 4 of these valuations will roll into our output tab. So let's go ahead and jump over to our stock screener. If you'd like to be able to download this spreadsheet, then you can head over to my Patreon page at the link in the description. But we'll come up here and we're just going to plug in the stock ticker for Coca Cola and hit enter. And again, let's come over here and glance at the dividend data. Currently paying $1.76 per share, gives it a dividend yield of right at 2.8%. A little bit of a higher payout ratio than I typically like to see, but this is a much more mature company than a lot of the dividend growth companies that I invest in. So that's actually going to be pretty normal, not too much of a red flag there. Now, the moving averages 20, 50, and 200 day are all positive. There are very few stocks where that is the situation currently due to the recent market downturn. Now, analysts currently have a target price of about $69 per share, so that is a bit higher than the current trading price. Institutional ownership is fairly high, right at 71%. And this company has an extremely low beta, so you're going to see very little volatility from this company. But let's go ahead and jump over to our first valuation model, which is going to be Graham's valuation. And this is a valuation model invented by Benjamin Graham, one of Warren Buffett's mentors, and this is the formula he laid out for us to calculate intrinsic value in the best investing book of all time, The Intelligent Investor. So the first thing we're going to do is we're going to plug in the earnings per share for Coca Cola, which you can see right here. We then multiply that by 7, which is the price to earnings of a company with no growth, and then we apply our growth rate projection. Now, we're applying a growth rate projection of 6 for this company. It's a little bit more mature, so we're not going to see as high of a growth rate as some of these other dividend growth companies that I do like to invest in, but 6 is still fairly decent for how old this company is. We then multiply that by the average yield of AAA corporate bonds, which is 4.4, and then we divide by Y, which is the current yield of AAA corporate bonds, and at the time of this video, that's sitting at 3.91. When we put all this together, we can see we come to an intrinsic value of $32 per share, much lower than the current price. Now, keep in mind, the current yield of AAA corporate bonds has changed quite a bit over the past few months. Earlier this year, it was as low as 2.8, so if you change it to 2.8 and hit enter, you can see you get a pretty different valuation. But let's go ahead and move on to our next valuation model, which is going to be our discounted cash flow model. And the idea behind our discounted cash flow model is we should be able to value a company based on how much free cash flow it produces in the future. And so in order to predict the future free cash flow, we need to project a growth rate to those future free cash flows. So fortunately, in order to do that, we're going to look at the historical free cash flow for the company, look at analyst expectations and industry expectations, but we have plenty of data on the historical free cash flow for Coca Cola due to how long this company has been around. We can see the average growth rate for it over the past 9 or 10 years is right at about 6%. Now, moving forward, I am applying a growth rate of about 8%. I think that's sustainable. This company is a free cash flow machine. So I apply that growth rate to the future free cash flows and the terminal value, which is the sum of all the future free cash flows past the year 2030. I then took the present value of those future free cash flows and added them together here, added the company's cash and cash equivalents, and subtracted out the total debt to get the equity value. I then divided by the number of shares outstanding to get our discounted cash flow price per share of $44 to $45 per share. Let's go ahead and move on to our multiples valuation. And what we're going to do with our multiples valuations is we're going to take companies that are similar in structure to Coca Cola, and we're going to take their stock price, divide it by the earnings per share to get our price to earnings multiple. And essentially, that's going to allow us to see how the market is valuing companies that are similar to Coca Cola. So then we take the average price to earnings multiple and we multiply it by Coca Cola's earnings per share to come to our intrinsic value of $71 per share. So that's actually pretty close to our analyst projections that we saw earlier on our stock screener. But let's go ahead and move on to our dividend discount model. Obviously an important valuation due to the fact that many people are interested solely for the dividend. But what we're doing is we're valuing a company based on how much they pay out in dividends and how much that dividend is increasing. So I plugged in the quarterly dividend payouts over the past 4 or 5 years so we can see exactly how much they are paying out yearly. And this allows me to see the year-over-year growth rate for their dividend. So we can see 2.5%, 2.5, 2.4, and 4.76. When we average those together, we come to an average growth rate of just a little above 3%. So not a whole lot of dividend growth over the past few years. Historically speaking, we have seen some higher rates, but this is obviously a company that's committed to continuing to increase the amount they pay out in dividends. As we saw earlier, they've been increasing the amount for over 28 years, which makes them a dividend aristocrat. So moving forward, I am applying a growth rate of right at 3%, close to our growth rate. After applying a discount rate of 8%, we can see we come to a dividend discount model price of $36 per share. Now let's go ahead and jump over to our output tab. And here on the output tab, we're going to see all four of our valuations: grams at 32, multiples at 71, discounted cash flow at 44, and dividend discount model at 36. When we average all four of these together, we come to an intrinsic value of $46 per share. Now before we apply our margin of safety, obviously we can see some pretty big differences in the valuations, like multiples and grams and multiples and dividend discount model. And one of the reasons behind this is we have to understand this is a company that's typically going to trade on a premium. One of the factors is because Warren Buffett is simply a holder, so that gives a lot of people confidence in the company. The company's been increasing the amount they pay in dividends for a very long time, and it's looked at as an inflation hedge due to how strong the company is. So people typically like to invest in companies such as this, Apple and Microsoft, during market downturns, and that's going to help keep this company at a higher valuation, a high price to earnings. If we jump back over to our stock screener, we can see currently a 28.6 price to earnings. So that is exceptionally high, but no surprise there. So current price, $62.97. If we go ahead and apply our margin of safety, let's say we're more aggressive when we apply a 10% margin of safety. Based on that, our acceptable buy price would be $41 per share, which is still a little bit below our intrinsic value, so it's still not a stock we should buy. If you're more conservative with your investments and you apply a 30% margin of safety, you can see your acceptable buy price would be right at $32 per share, so it's not a stock we should be buying. So full disclaimer, I did buy Coca Cola a year or two ago at a really good price, and I've seen phenomenal price appreciation. I plan on holding those shares and continuing to reinvest dividends into this company, but I'm not currently looking to add more shares at this current price. I have thought about selling out, but I think it's such a strong company that I'm just going to plan on continuing to reinvest my dividends. But go ahead and let me know what you think of this company in the comments down below. If you'd like to be able to download the spreadsheet, then you can head over to my Patreon page at the link in the description. So that being said, thank you guys so much for watching this video, and please don't forget to like and subscribe to the channel.